Welcome, guys. Welcome to the continuation of part 3B of the 7 Money Milestones webinar. Part 3B, which we will be discussing about investments. And those who tuned in on the first part 3A, they were watching Mr. Ron Harris talk about the Money Max account and IUL, Index Universal Life Insurance POLI program that you can get out of debt and convert your debts into wealth. So we're gonna get started in a couple of minutes. Enjoy the music. Welcome guys to part 3B. And basically those who tune in again, they were watching Mr. Ron Harris talk about the Money Max account and how can it help you, the middle class. All right. What I'm gonna do is probably it's good for you to watch the video again. So I'm gonna start it from the beginning, and almost from the beginning, the continuation where I left off. All right. But I'm gonna start a little bit. I'm gonna, rewind it a little bit for you to understand where, you probably didn't get what he was talking about. All right. So let's get started. Again, download the Bank Like a Bank app. There's the QR code. I'll leave a couple of seconds for you to download the app. Download the app. If you have any questions on the app, all the questions are inside the app, and they can help you to start the process to get out of debt. And also, I could help you too in my organization. I'm connected with Mr. Ron Harris' organization, Financial Literacy Group. All right. I will be your host, Mr. Carlos Anaya. So let's continue. So as you can see, I'm gonna skip the video. I'm gonna skip it to here.
However, it does not tell them not to spend money or not to do this. It just shows them the truth about everything they're doing. And it's based on paying off the debt as fast as possible. So again, it is flexible. So it just goes with the flow. If they have something that happens, the system understands that. If they have to spend more money, in a month, then they have less money left over in their budget. The system just recalculates. It understands that, and then it will take the money that it has left over. So if they go over a budget, then it has less money. If they go under budget, it has more money.
Oh, and how about this? How do you guys calibrate? It looks like there's inflation is very high. The cost of everything is going so high. Does that changes anything in your side because the costs are changing, constantly in the product and services out there?
Yeah, and that's another great question. So, and I've been doing this, for a number of years, and I was involved in this when interest rates were low, right? And people were doing a lot of refinancing at the time, right? Because they were finding, that interest rates being low, it's a great time to refinance. And what the system would do is it really would help them, even if they're thinking about doing a refi, because they could put the information that they're thinking, whatever they're planning on doing in the future, can put that information into the technology. The technology will tell them exactly how they will come out. So when I first put their information in, it will tell them what date they is planning they're going to have their debt paid off. It tells them how long it's going to take them to pay it off. It tells them how much interest they're going to save. Right. And so it deviates, like you said, to anything that happens in the future. So now with inflation, again, it's been adjusted, but it so what's great about this solution is that because inflation, think about this, if you have the technology and it is eliminating 75% of interest, so when you have a situation like we have now, when inflation is higher or interest rates are higher, it's going to eliminate more of the interest, right? So if someone has this technology and they go out now and buy a house, and they might not have as much competition because the person who doesn't have this kind of technology is going to be reluctant to go out and buy a house and pay the higher interest rate. But if you have the technology, the bank can give you an interest rate of 7%, and then you come back and you put it into your technology, and you're going to reduce that interest rate from 7% to maybe 2% or less, right? Because the
Mhm.
technology is going to, again, going to concentrate on paying the principal of that debt.
Got it. Got it. Okay. Interesting.
Yeah,
So how do people take advantage of this? So you saying this doesn't only apply to mortgage payment, you this apply to the life insurance, it
that's right.
applies to all those programs as well.
Any kind of interest bearing debt. So it doesn't matter if it's secured debt or unsecured debt, right? It doesn't matter. Not like if you're doing, a settlement or consolidation. In most cases, they're only dealing with unsecured debt, because if there were, if it was secured by something, then the creditor would just repossess that that debt or whatever it is that they're buying. In this case, they're not consolidating or sliding the debt in any way. There's it's a systematic or a strategic payoff. Okay? And
Hmm.
so where the life insurance comes in is that if they're using the money and they're moving into a savings account and then taking that money out of the savings account, using the savings account as an offset account, and then paying toward the principal of that debt, they're taking their money out of the savings account and sending it to the principal of the debt. With the life insurance policy, they're able to put that money into the life insurance policy as if it's a savings account, and then borrow that money out. What's really different
Hmm.
about the life insurance that we're using is if you find, that people online are saying normally bad things about IULs or 401, IULs, talking about what they can do and why it would be less of a great retirement vehicle. And in most cases, we are overcoming those different um, um, the different things that they're talking about. So first of all, they might be talking about the caps. When
Hmm.
you get a normal IUL policy, it normally comes with the cap if you're getting it from a normal life insurance agent, which means that it might be capped at 9 points. It might be capped at 12 points. So if the S&P 500, which is again tied to an index, goes up 45 points, you'd be capped at
Hmm.
9 points or 12 points. In this case, the policies that we use, they have no caps, and we're having the client invest in what we call a a volatility index. So we can buy multiple options on it. So it has no caps. Second thing that most people say about IULs when they're talking about them and comparing them to other kind of retirement vehicles is a surrender charge. And
Okay.
so in normal cases, when you get a life insurance policy, whether it's an IUL or a whole life policy, you can't borrow from the policy until you have met the surrender charge. So it might be 10, 11, 12 years before you can start borrowing money from the policy. So in that case, he's not going to help you pay off a debt that you have right now. You have to wait 10 years. The policies that we offer, like I said in the beginning, are more like the bank owned life insurance or BOLI policies. So we're giving people an opportunity to borrow from the policy. It's a liquid policy immediately. So in other words, they can put money, their discretionary income, into the policy and then borrow that money out right away and send it to the principal of their debt, paying down the debt.
Hmm. Got
Right?
it. Got it. You can stop the share run while we talking.
Sure.
So does that mean, if I'm understanding correctly, that is there certain companies that people have to take mortgages from, or as you mentioned, you guys offer also life insurance as well. So does that mean if I have a life insurance with a different company, I have to transfer that to your company, or mortgages as well to your recommended people as well? So how does that
Yes,
work?
great question. So the mortgages, no, right? They can stay with the same company that they have the mortgage with. We're just going to allow them to use a technology. That technology is going to give them instructions of paying toward the principal of the debt. So, a mortgage company, of course, they're not going to tell people that they can pay the mortgage early and eliminate interest because they want to get that interest, right? If it takes
Yeah,
them a long time to do it. And what amortization really and truthfully, no matter what the interest rate is,
yeah,
the mortgage company makes money on that that mortgage for the first 21 years. First 21 years, you're paying most of the interest on that mortgage. You don't really get halfway to your principal until you're in year 21. In this case, because of Dodd-Frank, the changes in the IRS code, um, people can pay down their mortgage no matter who the mortgage company is. And you'll see that some mortgage companies will put calculators that will tell people, hey, you can pay toward the principal and therefore eliminate interest. But if you normally cases, if you call a mortgage company and tell them that you want to pay down your mortgage early, they will tell you things like make double payments or pay more toward the mortgage itself. And they'll take that money and apply it to the interest. Right. In this case, they're strategically
Pay
telling the
attention,
mortgage company
guys.
that this money is going toward the principal of that mortgage, therefore eliminating that mortgage.
got it,
Right.
got it.
So life insurance, yeah, yes. If you go to a normal life insurance agent, yeah, you're not going to get the same kind of life insurance that we're offering. So we're offering the entire solution from the technology to life insurance policy, and together you're actually banking on yourself. You're banking yourself. So using
Hmm.
life insurance that we offer, um, again, you're changing your tactics because life insurance is again it has no caps, it has no surrender charges. So using the life insurance policy that we offer, they are able to pay down their debt faster. And now they've overfunded their life insurance policy with their actual mortgage debt. And now they're borrowing against their own debt and they're earning the interest on themselves rather than the bank earning the interest on them. So we have this kind of saying that you're either banking like a bank or you're
Hmm.
banking for the bank.
Got it, got it. So, and this applies to any business line of credit or business loans as well,
Any
Ron?
kind, yeah, anything that can be, that they finance, anything that the client is financed. So we've helped people with you know um the loans that were the PPP loans and all those kind of loans, the idle loans that came or out for businesses and then businesses were paying back. It's what's really funny is think about this. um, the way this solution works is really a solution that can be used, for just about any kind of debt. So, right now is a very big about the student loan debts, right? A lot of people are talking about them. If you think about things politically, right, we have the students or the people who owe on the loans, and then you have the Democrats, and in most cases, they do not want to pay the loans back, right? And then
Hmm.
you have, on the other hand, you have the Republicans and the lenders, and they want you to pay back the loan, along, of course, with all the interest. Our solution kind of falls in the middle. It's not political, right? It's kind of in between. So a person who has student loan debt can pay that debt back, eliminate most of the interest. So, and they're paying that loan off early. And now that student loan turns into income for them for the rest of their lives. Right?
I see.
Yeah.
Okay.
Yeah.
So they pay. Okay. So they're getting interest back. Okay, got
Yeah.
it. So let's say for somebody taking 100,000 in a loan, right? So let's say the payment is 500 a month. I'm just making a hypothetical number,
Sure.
right? So if I want to pay with your technology or your programs, let's say I want to pay off in 5 7 years, how many times I have to multiply my payments? That is going to be. Do you have any idea like how many times I have to add more to the payments for me to do that? Because that may not be affordable for a lot of people, I guess, right?
No, well, it's not that way. So, when you're thinking about it the way you're still thinking more like a consumer, right? Rather
Got
than
it.
thinking like a bank. right? And if I may, I'm going to share my screen again, if you don't
Sure.
mind, and I'm
Okay.
going to show you. Let me first of all, let me bring up this here and make sure that I have it open. Okay. So what you're going to see here is a spreadsheet that we use,
Okay.
and I'm going to again share this so you can kind of see it. So, you know, so what you see here is a spreadsheet, and it's called an arbitrage. This is a
Okay.
spreadsheet that banks use to calculate the money they make on loans. So
Okay.
when you're looking at it, a bank, I'm gonna grab my pen here so you can kind of see what I'm talking about. But a bank would borrow money, let's say from the federal government,
Mm-hmm.
okay,
Okay.
and then they loan that money to a consumer. They mark it
Okay.
up and loan it to them. So the
Yep.
bank then makes a spread
3.200.
on
Yeah.
that money. Okay.
Mm-hmm.
So here, what you see here is as if a family is buying a home,
Pay
and
attention, guys. If you have
the home
more
is
student
$400,000.
loan,
Or I'm taking it
okay,
back. The
Okay.
cost of the home
or
is
credit cards,
$350,000.
Okay.
Okay. But they're paying interest on that home. And let's say they're going to pay $250,000 in interest on that home. Right.
Mm-hmm.
So they would then, that's $600,000, right? 350,000 for the home, two hundred
Yep.
fifty thousand for the interest. But then they use the technology that technology eliminates 200,000 of the 250,000 they have in interest, right? So instead of paying $600,000 for the home, they're only going to pay $400,000 for that home.
Okay.
Okay, so what this number here is is this number, the number they're going to pay for the house, divided by the years they're going to pay. So let's say they're going to have the house paid off in 4 years. Let's say they're 55 years old.
Mm-hmm.
If they were dealing with the bank, they have a 30-year mortgage, 55 years old, in 30 years, they'll be 85 years old,
Okay.
right? Okay.
Mm-hmm.
Except, again, now they're paid off in 8 years. So they're only 63 years old.
Okay.
Okay. Right. So what you see over here again are the numbers, right? And again, this is pretty conservative, because when I'm illustrating this, I never really go to higher numbers. So I tried to be, very conservative with this. So as you can see here, this is the profit. So this same person now becomes this bank. Here, they're
Mm-hmm.
going to put the money, the discretionary income into the life insurance policy over
Okay.
8 years. Okay. So what you see here is that. Right. So at the end of this 8 year period, they're putting the money in. Life insurance company, and I'm showing this, is allowing them to borrow that money out. Let's say borrow 95% of the money that they put in as they put it in. So
Mm-hmm.
at the end of the 8 year period, their loan back to the life insurance company is $431,000. However, in this case, because they're not using a savings account or a HELOC, they're using a life insurance policy, that money stays in the life insurance policy. Okay.
Mm-hmm.
So that means they are earning the spread, right? They're earning the spread, that 3.25% on their money in the life insurance policy. So at the end of the same period of 8 years, their loan is 431, but their cash value has grown to $505,000. So they earned the spread while they're paying off their house. So they earned $72,000 from the life insurance policy.
Mm-hmm.
Now here they are, they're 8 years into it. They paid off the house. It's done. They have no more debt. Okay. But they have the equity in the home, but they also have in liquid cash $73,000.
Mm-hmm.
Okay. Now, CDC, right? So CDC says people are not retiring at 65 anymore. They're retiring at 70 years old. So they're working extra,
Mm-hmm.
right? So what you see here in this yellow line, so this orange line is their debt. They're paid off of their debt. This yellow line is when they retire. So as you can see here, the loan has grown now at 70 years old to $679,000. But the cash
Mm-hmm.
value, which is growing faster than the loan, is now $965,000. So again, they're earning the spread on their own debt, on
Mm-hmm.
their loans. So they have now $285,000 in liquid cash from paying their home off early.
So how much were they were paying monthly on this, Ron? If you just use the same example, what was the payment look like? What did they pay?
So it would be the same. So what they would be paying here is the technology, and so that's a great question. What I'm showing here is that they have only $600 in discretionary income. So they're paying their normal payments, they're paying off their debt, and they're taking $600 that they have left over, and that's where they're starting in the beginning, right? But
Mm-hmm.
as they pay down the debt, this discretionary income is going to grow, right? Because they have less debt to pay. And now
Mm-hmm.
the $600 continues to grow. And so, as you can see here, again, I'm basing it on a very conservative number, which is the $600 in discretionary income. So they're paying their debt payments, whatever they are, to pay off the house in 4 years or 8 years, right?
Mm-hmm.
And now their discretionary income is going into the life insurance policy.
I see. So they're paying their the house for the house, and they're paying 600 on top of that for the life insurance.
That's right. Not well, yeah, for the life insurance, yes. So the life insurance, and it, it's very funny, because of what you're asking, and there is a cost of life insurance. However,
Mm-hmm.
as you can see here, actually earning money on the life insurance policy. So the premium or the cost of life insurance really doesn't matter in this case. Right?
Mm-hmm.
And following, if you remember that sentence that I read to you about, you can make a life insurance, right? Doesn't matter what the right how much
Yeah.
the premium is or the value of the life insurance. So all I'm concentrating on when I create this life insurance policy is what they need per year, which is this number right here, to pay off
Yeah.
their debt in time in the 8 years. So if they average this amount over the 8 years, they can pay off the house.
See.
Right,
Yep.
right, right.
Mm-hmm.
And this is really just the beginning. So
Mm-hmm.
let me show you that it can go further. So what you see down here is now they've turned 85. Again, the CDC says if you live to be 65 years old, in most cases, a couple, one of them is going to live to be 85 years old.
Mm-hmm.
Second person in the married couple is going to live to be 92 years old. So as you can see here, grab my pen again. They've actually, by 85 years old, they've earned $1.8 million from the life insurance policy.
Mm-hmm. Interesting.
So now think about where they are. They've saved $200,000 in interest. They
Mm-hmm.
saved 22 years of paying the bank. They are now debt free at 63 years old. They own the house, so they have the equity in the home. Their life insurance policy that they overfunded with the debt is earning interest. And now at 85 years old, not only have they paid off the debt and they saved all the money and then the interest, but they have an additional $1.8 million.
Interesting. Mm-hmm. Got it. Okay.
Yeah.
Let's talk about your business, Ron. How's your where's your revenue come from? Is that technology that you guys sell? Is it an app that you guys sell, or is it from a consulting? Where do you guys come from?
So great, great. So our it's funny because our income comes from the technology, right? So we are, representing and working with the developers, and they're continually updating the technology. So we get paid, from the technology, but it's very inexpensive, right?
Mm-hmm.
Especially compared to what it does. I've had people, um, you know, that have $80 in discretionary income, and I've saved them $360 in interest, right? So
Mm-hmm.
the technology itself really is a solution that they can afford, and we can finance it so they can pay for it, monthly, and again wipe out a lot of their interest. Um, as far as the life insurance, and it's funny, we really take the hit on that because we're offering the same kind of life insurance policy that Bank of America would be using, or a BOLI policy. We're allowing them to take all the money out of the policy as they pay on their debt. So we don't get paid in advance like normal life insurance agent would get. Once they get a policy, we get paid in advance. We get our money spread over 6 years, right? So what we're doing is we're taking the hit, right,
Mm-hmm.
for helping the person build generational wealth by from their debt. In other words, so yes,
Got
so
it.
we get less money, yes, and but we get more clients. So the more clients that are getting involved in this allows us to keep the volume up. In other words, so we make our money through volume rather than an individual amount of money in an advance for the life
Got
insurance.
it. Got it. So people can. So how do they access the technology? Do they download an app on their phone, or is it a website account they
Yes,
start? And how does that work?
it is a SaaS program, right?
Okay.
So it's a program that they can go to on their computer, they can go to on their phone, and they can access it that way. And so it makes, like I said, it makes them smarter about the money because it's really like a bookkeeping solution, but it's much smarter than that because it gives them ideas of what to do. It tells them what to
Yeah.
do. It tells them how they can eliminate their interest. But
Yeah. There's a
it
lot of
is
consulting and guidance built into that, right? So walk
built
people
into
through
it.
here. Let's say,
Yeah, yeah.
interesting.
So it's funny, because we started with the conversation about financial literacy, and I would say that this app or this solution um, is instant financial literacy. And what's really funny about it, when I've learned about it, is that it changes the way people look at their debt. Right? People have been doing and paying their debt a certain way all of their lives. They've been,
Hmm.
paying it. And in many cases, they come to us and they're in trouble, right? They have, bills that are piled up. This technology makes them smarter. It's like instant financial literacy. So it makes them smarter about their cash flow, makes them smarter about what they're doing. They think twice about buying things. They can see what it would cost if they did something, and it tells them the truth about it rather than,
Yeah.
through rose-colored glasses, right? And
Yeah.
exactly, yeah.
Something magical about when you show people that consequences or result of their decisions is that then very often people change their decisions when they're trying to make some decisions on an ongoing basis, right?
That's right. That's right.
When you show them, hey, if this decision is going to impact you this way,
That's
a
right.
lot of things changes. People's
That
perspective changes,
that's
right?
right. Yes, and what's really funny also is the software has a true cost button. So in other words, somebody can be spending some money. Maybe they had a flat tire, or something that happened, kind of off the cuff, and they can put that in there that they're going to be paying for that, and the app will tell them how much that is really costing them, even though they're writing a check for a certain amount. It tells them this is what the real cost of that is. So they can see what it costs them. So even on things that they want to do in the future, like they want to take a vacation or they want to buy another car, right? They can see the real cost of those things before they do it. And that's what is really good about the app, and again, it keeps track of everything. Right?
Do you
So
guys get into keeping a track of credit cards and all that, the cards as well, or
all
is
of
there a
those
different?
things, that's all of those things.
Okay.
And the app, it also gives them advice on things like, for instance, people don't realize that you can get a credit card, right? And it doesn't matter what the interest rate is on the credit card, but you can use that credit card to pay your monthly expenses, right? Those things are you're paying with cash anyway. So if you put those things on a credit card, that is giving you money cash back at the end of the month, and then you pay those things off as if you would do if you were paying cash for them, you would eliminate the interest on that credit card. However, the bank will still throw you the cash back, right? So they're almost getting paid for using a credit card on certain things, right?
Hmm.
And so we showed them how to do those things. And by the way, we have an app for this solution. So you can go online. You can, if you have an iPhone or you have an Android, you can go and download the Bank Like a Bank app, and it will show you how this all works as well.
Got it. So it's called like a bank app. Is that what it is?
Bank Like a Bank. That's what it's called. The Bank
Like a
Like a
bank.
Bank app.
Okay.
Yeah.
Okay.
Yeah.
Very interesting.
Yes.
So let's talk about your journey. On how did you get involved in this, and what you've been journeying, and what got you interested in getting into the app or technology business?
So I've been in technology all my life. So before this, I was more in kind of security and drones and those kind of things. But I did a lot of research, during those days. And so when I got involved in this, I got involved because I myself was in debt. Right, I went through a divorce in 2006. I had a home that I had bought, before the divorce, and when we went through the divorce, I ended up, paying my ex-wife half of the equity in the home. So I ended up underwater in that first
Hmm.
home, and I had bought a rental property and I lost the equity in that home, and so and a friend of mine introduced me to this technology, and I saw how it could help me and put me in a better track to pay off that house, which I was underwater on, and also to make equity on the second home. So I still use it now, kind of more offensively, right? So I'm using the app. I use it originally to pay off my debt, and by the way, I went between um, 2010 and 2017, I paid off over $1.2 million using this app. Okay. And now I'm using it differently because now I'm buying properties, and I'm able to pay those properties off early. I'm leveraging this technology so that I can get to the equity in my homes much faster. Yeah, so that's how I
See.
kind of get started in this. Is I'm just like everyone else, you know. I had problems with debt and credit cards and cars, and this app helped me fix my problems.
Got it. So this app is built by as somebody in a US. Like, who's this built by? And
Yes,
and you become you become a reseller of the app, or how
yeah,
does
so
that work?
yes, so I'm a partner with the app, so I'm an executive director there. So
Okay.
and I work closely with the developers, and tell them what they need to do, what they need to add, and they're continually updating the app. Yes, it's a United States app. It's really the developers out of Utah, California, out of Utah,
Nice, nice.
Salt Lake City, Utah. In fact,
Got it.
yeah.
Yeah, it makes life much easier when you have a direct access to developers. You can influence what changes need to be applied, and then they can changes as you see that experience, or you see your customers are dealing with what kind of challenges they're dealing with, and you have access to developers. You can get them to change whatever issue they need to tackle on a customer
Yeah,
side, right?
yeah, absolutely. And before the life insurance came, or this change in the IRS code came along, I was offering life insurance. So I would have people, they would purchase the app, they would pay off their debt, and then I would go back and offer them life insurance. But after the codes changed in the IRS codes changed in 2020 CARES Act, and the reason they did change is this, because people were dying of COVID in 2020. Right, when a
Hmm.
million people died, right, and so the life insurance companies, in most cases, are they're investing money, but through the bond market, because they were paying death benefits for these million people that died during COVID. They didn't have a lot of money left over to put in the bond market, right? So the
Interesting.
bond market was hurting. So in order to help the bond market, Congress changed the IRS codes, and so we noticed the loophole there, and so we saw that because of these changes in the IRS code, we can use a life insurance policy as an offset account, substitute the savings account using a life insurance policy, which allowed our clients to not only pay off their debt, like they were doing using a savings account, but now to make money
Hmm.
by borrowing that money from a life insurance policy and pay that debt down.
Very interesting. Very interesting.
Uh,
So where has been some of the bigger challenges, Ron? Definitely, the people not aware of it. That's going to be the biggest challenge. Where other challenges been that for into this to the it's such a great technology. I'm just wondering why people are not using it, and what's been your obstacles.
Well, people are starting to use it much, much more because they're starting to understand and realize the differences, and we try to point those differences out. So I would say that one of the biggest challenges definitely is getting the word out. And in the beginning, and again, remember, this part of the solution is not that old. And you know, after 2020, right? So 2021 is when we started, March or April of that year. And in the beginning, we were pretty naive ourselves. We knew that this was a good solution, right? And we understood how it worked. But of course, we've learned more and more over this last couple of years ourselves. But in the beginning, we were thinking that we would advertise this, right? We would go out and we would place ads, and we would talk about what we're doing, and we would tell everyone that we're doing. But then we decided that we didn't want to do that because we don't want to make the banks angry. Right?
Yeah.
We don't want the banks to be our enemies. We also need the banks. We still need the banks to loan people money. And so one of the biggest challenges is how to talk about this, how to get it out, how to organically getting it out without advertising and making the banks. By the way, just so you know how I know this is because we're a minority company. And so I joined the National Minority Development Council, and so every year they have a national conference, and so they look for companies to write information that could help maybe close the wealth gap, or help businesses so they can you know get contracts with larger companies. So a couple years ago, I wrote a thesis, and so I went to speak at the event. but my my speech was about how people can overcome what the banks are doing, right? How they can, not pay interest. And this event happened to be sponsored by the banks, of course.
Oh.
So so of course they didn't allow me to speak at this event because hey, I would be speaking on the stage talking about the guys who were the sponsors of this event. And so it made me also realize though that, if they don't want the banks to be angry, we don't want the banks to be angry either, right? We don't
Yeah,
want to tell the
yeah.
banks that we're doing, and it was better for us to kind of, do this organically. So what we're doing is we're bringing in more agents, and definitely looking for agents if you're interested in that, and helping people, right? Because the key for us, in this solution is that we are helping clients. Okay? We're making money as agents, of course, and we have technology and so on and so forth. But for the person, for the end users, for the families that we're helping, is changing their lives, and that's what's really big about this. Yeah.
Yeah. We're gonna put this on a YouTube podcast. I'm sure no bank's watching my podcast, so not to worry about it. There's no banks gonna listen to my podcast, so you don't have to worry about any of that stuff.
Okay. All right.
Good stuff. Hey, listen,
Yeah.
I learned so much from you. I think it's a great technology. People should, learn more about it and go have a take a look at and definitely connect with you and get some more details.
Please.
We never gonna be able to understand or learn everything from social media or from a website, but maybe discussion with you, connect with you and learn a
Absolutely.
little bit more about you and see how this technology can help them to make them get them debt free and much sooner that they would do without
And
it.
it's funny because we advertise on Facebook, right? So
Hmm.
clients come to us, and because they want to pay off their mortgage debt, and and we not only help them pay off their debt, but we show them how to make money off of paying their debt. And so, people are really skeptical when they come to us because they've been taken advantage of. They've seen lots of ads on Facebook, and they think we were just a normal. It's funny. I've had people come onto the calls, and usually I'm booked all day long, and they come into the calls and they're saying, "Well, this is already different because it's not a recording.
Yeah.
You're not speaking with some kind of accent or something like that. And so
Yeah.
they're pretty skeptical when they come there. But again, we on our website, which is financial literacy dot group is our website. We put lots of third party information there, so lots of places, lots of information for people to go and research it and to do the due diligence and understand what we're doing. And I think those things are really important. So we don't really try to sell that much on the website. We really that site is there to support what we do. And by the way, we do have not only the financial literacy group website that I just talked about, but we have a betterment site. So we're also using this as an employee benefit, right? So
Nice,
employers
nice.
and employees as well. Yeah,
Yeah, no, definitely we're going to put our discussion on all the social media and which with your contact information as well, and spread that awareness a little bit, right? Educate people. Maybe people will connect and hopefully they will reach out to you for discussion and see where who knows where discussion can take them, right? So,
absolutely.
but we'll definitely include what is the best way for people to connect with you, Ron. What is the go to method to have a chat with you?
Yeah, definitely. So they can book me. So of course they will find me on Facebook. But if they go to the website, there's plenty of places for them to book an appointment. So I would say booking appointments is one of the big things, but they can also call. And the phone number that we have is area code 323-419-1600. You can reach me there. My extension is 1005, but you can reach any of the agents there. And we consider ourselves, financial literacy group professional educators. So we educate people on what they can do for their debt. And again, we're an alternative. We're totally different from whatever everything else is out
Again,
there. So
guys,
we're not
Nice.
advocating mutual
that's
funds
Ron
and
Harris. He's
and
my
you know
mentor. He's the one that
401ks and
taught
those
me
kind of
how to
things.
get
We're
out of
kind of
debt.
an alternative to that.
So this program is
Yeah,
also
and well,
in
definitely,
Connecticut
I learned so much
also.
from our discussion. I'm
And
sure
you
business
can
leaders
reach
are
me at
watching. If you're looking to,
203
deal with your business
738
loans or any line of credit, if you want to pay that faster, connect with you.
14
You'll learn so much from
extension
your discussion.
1001.
So definitely,
Or you can
I
call
will
my
list your
hotline
phone number and email, all
anytime.
the website below
If
this
you want more
video as
information
well, and
about this,
encourage all my colleague business
how
leaders to,
to pay off your
pick up a
mortgage
phone and
early, your
talk to you
student
and figure
loans,
out
your credit card debt, and
how
so on
you
and
can
so
help
on,
them.
Great,
you can reach me
please. I would love that.
at 260.
Looking
Thank you
forward
so
to it.
much for your time, Ron.
1173.
Thank you so much.
Make sure you
All
leave
right.
your name, your email, your phone number. All right, guys. Now, take a little break and enjoy the music. All right, guys. I hope you enjoyed the video. Now we're gonna go to part number 4. All right, part number 4. So stay tuned for part number 4. We're gonna be talking about the simple credit repair personal success course, a mini course, so that you guys are gonna see in this next part of part 4 of this webinar. So again, I'm breaking down this webinar into hourly parts, 1 hour part on the webinar. All right, so this is part 4, 4A. All right, so we're going to be talking about credit. We're going to focus on credit, guys. Credit. All right, credit, debt, history of credit, a little bit of everything about credit. All right, so make sure you got your pen, your notebook ready, because there's a lot of writing to do. All right, so you have a great day. See you in part number 4A, which is coming soon.